Why should you listen to me about investing? My first career straight out of college was working at the University of Oregon Foundation in the investment office. And when I started there, they had about $200 million of endowment assets that donors had given them over the years. And 13 years later, it had grown to 700 million. I worked with a small team of people who interviewed professional money managers from literally all over the world and heard from some of the smartest people in the business. So that was a great background of experience. And I'm here to basically take everything I learned there and share it with you guys to give you the best shot at being successful investors. All right, agenda for today. I'm going to talk about the big picture of why investing matters to you. We'll talk about the who and why of investing. We'll talk about where people invest, which is this great big place called the capital markets. We'll also talk about what do people invest in, stocks and bonds, for the most part, when you should invest, and a couple of different investing principles and pitfalls will be shared throughout the presentation. So that's what you can expect from today. Big picture. Number one, you are in charge of your retirement. There is no big brother or employer. It is up to you to save, to have enough money, to have the lifestyle that you'd like beyond the Social Security check when you turn 67 years old. Yeah, fingers crossed that Social Security exists in the current state, or that you'll even get a full payout. Like some estimates suggest Social Security might have to be cut 20 to 30% to even be able to cover everybody who needs to draw from it. You're in charge of your retirement, your family's future opportunities. You're in charge of how much you save, and you're also in charge of how you invest. Like employers, for the most part, have said, we're going to give you the tools, but it's your responsibility to learn how to use them. And oh, by the way, if you do it wrong, we're not liable, guys. So yes, it's on our shoulders. I also think it's super important to learn about this, especially women who are systemically undereducated in the investing world, because it will protect yourself from others. Where there is money, there are people who want to take advantage of it. It's why it's so important to work with a fiduciary if you do choose a financial advisor to work with, and also to protect from yourself. There's just lots of different ways you can go wrong in investing, and knowing the basics, like which holes not to step in, is a great place to start. And then finally, this is just necessary for all of your future financial goals. Saving alone is not going to beat inflation. It's not going to grow your wealth. Having money in cash is really, over the long term, losing that big picture. Why do people invest? Basically, it's when you're an investor, when you have money right now that you don't need to spend for some amount of time. So there's this thing called the time value of money, meaning that if you have $5 today in your pocket, it's generally better than having $5 in your pocket tomorrow, because there's this opportunity cost. When if you don't have the money now, you're giving up some ability or some action that you could take today. The way you measure the opportunity cost of having money now versus later is basically an interest rate or a required return that you need as an investor. And it's measuring that opportunity cost. Typically, it's measured as a percent. So basically, if you're an investor, you are a shopper and you are shopping for returns. An important note, we're talking about investing. We are not talking about speculating. Jim Cramer, oh God, this guy is the worst. He's always like ringing a bell and telling you to like buy a bunch of stuff right now and then sell it tomorrow. It's so short term and just so bad for you. These guys are like traders on the floor of New York Stock Exchange. They are buying and selling and bidding and asking, but that's not what we will do. We're also not caring about what the market did in the last 6 of the last 8 days. Investing is for years and decades, not for 8 days at a time. And we are not investing in trends. Can you make a lot of money investing in trends? Yes. Can you consistently do it? No. Can anybody consistently do it well? No. So the kind of investing that I am talking about today is We're going old school, you guys. We are Warren Buffett investing. And we're not even going to use a style, but we're going to use his flair for investing, which is basically like, if we're not talking about 10 years, don't even think about 10 minutes. Like if you want to own a company, if you want to own a stock, an individual one, as you go that route, this is a long-term thing. Paul Samuelson, he's another kind of big investing name over the years. He says, investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Vegas. So this is what we're talking today. We're talking about like your future 20, 30 years. There's all sorts of different types of investors out there. I've ranked them in font size from largest to smallest. I'm hoping to help you understand where you as an individual kind of fall in this big picture. But in the global capital markets, there are lots of levers. Number one, governments have lots of money that they need to invest. So think about like Social Security and all of these other kind of benefit plans that people pay into over time, but don't necessarily get paid out right now. There's also corporations. Corporations have tons and tons of cash just sitting on their balance sheets and they invest it. There's also insurance companies. So every time you make a monthly premium, they are earning money on your premiums. There's also state and corporate pension plans. If you had the luck of working for an employer like the state of Oregon, and they guaranteed you a certain amount of money in retirement, they're investing for that. There's also universities and endowments that have big pools of money that they invest. And then finally, there's individual investors. We're a smaller piece of this puzzle, and there are a lot of smart people working here who are trying to beat the market. We as individual investors are going to say, we are going to invest in the market and take what the market gives us. We're not going to try to beat it because that's really a losing game for individual investors. Where do people shop for returns? Where do they invest? They invest in global capital markets. This is where people with the money come to buy assets, securities, bonds, other financial assets. And we'll talk specifically today about stocks and bonds. There's basically two main types of capital. There is a stock and a bond. A stock is a partial ownership of the future profits of a company. So you are owning a piece of the company and you get to participate in the profits, whether those are positive or negative. A bond, in essence, is a loan. It's a loan to some entity. It could be a corporation or a government. There's lots of different places that issue bonds, but you don't get a share in the profits. You get a return back for the money you loan them. Bonds, you get paid for interest payments twice a year, typically. And then at the end of the term of the bond, they give you your money back, which is called principal repayment. How do you get exposure to these things? How do you invest? You can buy an individual share of a company. Like you could go out and buy one share of Apple if you wanted to. Or you can go out and buy one share of the S&P 500, which is an index of the 500 largest companies in the United States. So say you had $100, you can buy some portion of one company or you can buy some portion of all of the companies. Investing in funds is a very good way to go when you're an individual investor with not a lot of money because it provides you a lot of diversification with a small amount. Same thing with bonds. You can buy an individual bond or you can buy a bond fund. Stocks have done about 9% a year on average. This is lower than what they've done recently. If you look at the long history of stock market returns, 9% is what you should expect. The US stock market has done more like 16% a year for the last 10 years, which is really wild. How much can you make in bonds? Typically about 4 to 6%. It's kind of like whatever inflation is plus a couple percent. A stock of Apple, a share of General Electric, or you can buy the index fund, which is 500 of those companies. With bonds, you can own a treasury bond, which is a loan from the US government, or the state of Oregon issues bonds. Companies issue bonds, like General Electric sometimes wants to borrow money from people. You can also invest in a bond index fund. And the reason why people want to own stocks and bonds are two different tracks here. Stocks, remember, you get to participate in profit. So you want to own those for capital appreciation and growth. You want your money to grow over a long period of time. Bonds, people are mostly focused on preserving their money and getting a little bit of return. So which one's riskier? Stocks, because you don't know what your return is going to be. Bonds, there's a good chance they pay you back if they don't default, and you'll get your interest along the way. So big picture, you own stocks because you want to grow your wealth and protect against inflation from eating it away. And with bonds, you basically own them because you want stability of your money, and you also want to own them as an offset, if you will, to stocks, because stocks and bonds perform differently in different markets. When bonds go down, typically stocks do well. And so you can do this thing called balancing, where you're selling the thing that's holding its value and then reinvesting in the thing that has now gone on sale. Okay, that finance guy says, but what about investing in real estate and insurance annuities and gold and silver and currencies and cryptocurrencies? Have you bought Bitcoin yet? We can talk about all of those in Investing 201. Today is just stocks and bonds. They are unregulated and they don't have 150 years of returns to look at and have confidence in. And so depending on your risk profile, I would say all of these could be suitable for regular investors if it's done in the right amount and for the right reasons. Should you put your emergency savings in Bitcoin? No. Should you bet your retirement on gold and silver? No. Those are stock and bond type things. If you had some extra money and you are really interested in learning about a new market and participating in it over time, despite the many, many fluctuations up and down, then put your extra $1,000 into a crypto fund and experience that. Let's speak the same language. So let's talk about some of these like big investing terms that people use all the time. At the end of this, you guys are going to be so smart. You're going to be using all of the buzzwords and people are going to just be, what? Where did you learn it? No different species. What do they use when they say the market? So these are common phrases that you hear on the news or in the newspapers about the stock market, particularly in the US. So S&P 500 means the Standard & Poor's stands for S&P. They put together an index of the largest companies in the US. Another index, it's got 30 companies that have historically been more like industrial names. The Dow stands for Dow Jones Industrial Index, the DJI. These are some of the oldest companies, and they kind of give you a sense of how the real economy is performing. If you hear the word the NASDAQ, this is often seen as representation of the technology sector. So this is where all the big tech giants are located. You know, you got your NVIDIAs, your Apples, your Meta, Microsoft, Tesla, and so on. What the heck is a bull or a bear market? A bull market is when stocks go up. A bear market is when stocks go down. The definition of a bear market is a 20% decline from its previous peak. So you can see that this goes back to 1950. There have been bear markets pretty regularly through these periods. A little less regular in here because of the 0% interest rate policy that juiced the stock market into a giant tech bubble in 1999. We've also got the bear market of the great financial crisis. I've lived the markets for each of these bear markets. There haven't been a lot recently, which I feel like has really lulled a lot of people into discomfort with investing in stocks. It's always good to look at history. We're currently here This was actually from last year. We're kind of like here today in terms of the current bull market. Some other terms that we can review together. Asset allocation. What does this mean? It means what's in your portfolio, what's your stocks, what's your bonds. If you're 60% stocks, 40% bonds, you can say, my asset allocation is 60-40. What's a portfolio? It's the whole pile of money you have. And again, the asset allocation is however you spend your money into different asset classes becomes your asset, the asset allocation of your portfolio. A correction or a pullback is when the market falls from its previous highs. Timing the market is meant to say that you are making a decision to enter and exit the stock market based on how you're feeling about things. Are you feeling scared? Do you just have some prediction that the market will do something in the future? Timing the market means jumping in and out. Diversification means that you own more than one thing. So you're not concentrated in any one particular company, government, that kind of thing. Risk or volatility in the stock market tends to mean the same thing. And it means how much is the price of the market you're invested in going up and down. If it's small moves, the volatility is low. If it's big moves, the volatility is high. A mutual fund or ETFs, you might hear these words quite often. They are both similar but different structures about how to invest in a whole index, like the many companies rather than just a single company. Mutual funds typically are invested by money managers who want to beat the market, and they charge you an extra fee to make those choices in that fund. ETFs stands for exchange traded funds. They are typically more just like index funds. They are just going to give you broad exposure to all of those individual companies for a pretty low fee. Okay, let's look at some of these words in action. We'll look at some historical charts of the stock and bond market. Okay, so this chart goes back to 1928, and it basically shows you that over time, stock markets go up. Notice that this doesn't go like this. It's over long periods of time. There are these tethers to the stock market called valuation that pretty much keeps things from going too long. Remember all the bulls and the bear markets? There's a cycle to this. And if the market gets too expensive and runs too high for too long, typically there's going to be a pullback or a correction to bring it back into balance. We have been through some pretty crazy things, like the Cuban Missile Crisis. Like the stocks have survived that. They've survived stagflation, which is a time when both the economy was doing bad and inflation was high. Those were bad times. We've survived wars. We've survived tech bubbles and housing bubbles, financial crisis, and the pandemic. So a lot of times when I'm talking to clients and they say, oh, aren't you worried about this or that? I'm like, yeah, but people were pretty worried during the Cuban Missile Crisis too. Literally, people thought they were blowing up the next day. Like that was terrifying. The pandemic, also terrifying. There are lots of things to worry about. However, if capitalism survives, the stock market will go up over time. It's just the way it works. So this is a chart of 10-year rolling returns. So what this means that if you invested during the 50s, in 1960, if you looked back at your returns, you made a ton of money. This was called the Nifty 50s, by the way. Like all of these companies like Procter and Gamble, people came home from the war and they bought refrigerators and couches and new homes, and stocks just went gonzo. And it ended fantastically with this big drawdown over the next couple of decades when people didn't do as well in the stock market. Beware of when people say stocks go up 20% a year every year, guys. You can count on it. You're probably here or here. And then when you're hearing people say things like, oh, my stocks were down 40% and I just sold it all, couldn't handle it anymore. It's because their 10-year returns were negative. So we are in the stock market goes in cycles. And right now we're about here. So I don't know what's going to happen in the next year or the next 3 years or 5 years, but I have a good sense that maybe stocks aren't going to do great in the next 10 years. We'll see. It's to be expected. And it's all about adjusting your expectations and being ready when the buying opportunities come. Okay. This chart, again, big words, pullbacks, drawdowns, intra-year declines. So remember, a drawdown or a pullback is when the market comes off of its previous high. There are going to be lots of these during every year that you invest. If you ever see your portfolio down 8 to 9 to 10%, just know that's super normal. If you see your portfolio or stocks down like 30, 40, 50% during the year, those are extraordinary times. So if the market back in April this year, it was down 16%, similar to where it was in 2010. In April, the stock market was down 16%. And a lot of clients that I managed money for were concerned and said, oh my God, these tariffs are terrifying. And I said, okay, I get it. I also am concerned about where the economy will go. But I also know that this is a normal range for markets to pull back. And if I'm investing for you for the next 20 or 30 years, now is a good time to add money. And we did for many of my clients back in April. And now they're up like 30% from those. So having the discipline to not be afraid to invest when the market is down is one of the biggest takeaways that I get. Stock and bond annual returns. This gives you that sense earlier. Remember when I was saying stocks and bonds perform differently in different market environments? This shows you in the dark blue what the stock market did in the tech bubble burst. Look what bonds did during that time. They were up almost 10% a year. If you had a diversified portfolio when the stock bubble burst, you did all right. You actually didn't come out of there too bad. If you were invested in all tech, you had a really hard time. So there is a benefit to being diversified. Recently, in 2022, both stocks and bonds went down at the same time. And it was because we had an interest rate period that went up. When interest rates go up sharply to do something like, say, fight inflation, both stocks and bonds get hurt. But Stacy, should I keep holding bonds right now? They recently performed really bad. The answer is yes, you should have bonds right now because interest rates are not zero. Interest rates are at 3 to 4%, and that it's not likely for them to go up. It's probably more likely that they go down at some point in reaction to an economic shock. And when that happens, stocks are going to do good, bonds are going to do good. So I believe in having a diversified portfolio of stocks and bonds right now. Staying invested. This is a chart that gives you some sense of what would happen if I tried to time the market, jump in and out. If you stay fully invested through all the last 25 years of the S&P 500, your $1,000 could turn to $3,600. What if you got out and missed just the best day before you got back in? You could lose $400 return. What if you missed the 5 best days? Now you've lost about a third of your return over 25 years. What if you missed the best 10 days and so on? And basically it's just trying to say that, like, if the market goes down a lot and you sell here, typically what happens is there's some sort of news or action that takes place and the market will have these big updates, like up 8, up 10%. And if you miss it, you really miss that opportunity to have a long-term return that's similar to what you can expect from the market. Okay, I'm going to try to leave some time for questions. This chart just tells you what you can expect from buying and holding the stock market. You could make almost $1 million if you started with 100,000. at the end of the last bear market? What if you, at the top of the market, you just went to cash? Or after this down period, you just went to cash for a year and then reinvested? You would lose almost half of your return. Finally, if you just need the cash period, you're no longer in the game. You already lost out on even returning to where you were before that. Stocks and bonds come in different flavors, and there's all sorts of different stocks. You can invest in growth stocks or you can invest in value stocks. And the difference between those are growth stocks are typically companies that are not paying dividends because they think that the benefit of reinvesting their capital back into growing the company is so high that they're like, trust us, someday we're going to pay you a dividend, but not today. You're going to get all your return on earnings growth and price appreciation. And that can go on for a long time if the company continues to grow strong. But if it ever misses its growth earnings estimate, then those stocks get punished. So that's a more risky way to invest in a stock. A value stock is just, these are your blue chip, your Dow Jones industrial averages. They are not sexy. They pay like a 4% dividend every year. They're a mature company who's been around for a long time. They know what they're doing. And if you invest in those, you're probably not going to get really great returns, but they're going to be more steady. You can invest in large cap stocks. These are the names that you hear all the time: Amazon, Meta. Or you can invest in small cap stocks. And these are smaller companies. They're still large, kind of like a small business locally. These are companies that are still making hundreds of millions of dollars. However, they tend to be more exposed to the local economy of the US, as opposed to large cap companies where sometimes 50% of these large multinational companies in the S&P 500, sometimes 50% of their revenue comes from outside the US because they're global. You can invest outside the US as well. Imagine a brand name like Louis Vuitton. That's not a US listed stock. Schneider, they make all of the escalators and elevators around the world. They are a German company. So investing outside the US does not mean taking a lot of risk. Oftentimes these companies are also large and mature. There is a riskier way to invest in international stocks. These are called emerging markets. And they are in countries, they call them the BRICS: Brazil, Russia, India, and China. These are the 4 countries in the world where the middle class of their economies are growing fastest than anywhere else in the world. And so if you want exposure to those potential returns, you should have some amount of money in emerging markets. You can invest in the US government, you can invest in a bond for 1 year, or you can invest in a bond for 10 years. You can invest in municipal bonds. You can invest in bonds that hold mortgages across Fannie Mae and Freddie Mac. These capital markets are huge. They're worth like $140 trillion. Believe me, all of these guys that we saw in those pictures, they are figuring out a million different ways to invest in different kinds of things you can invest in. The flavors don't always perform similarly. And this is why you should be diversified across not just stocks and bonds, but in your stock portfolio, you should have international stocks. In your bond portfolio, you should not just be relying on the US government to pay you that. Be diversified across all of these because you never quite know which one is going to be the best. But if you own a little bit of all of them, you're going to be in good shape. And then finally, just look at this picture. This is a pie chart of an asset allocation. Remember the mix of the assets in your portfolio. This is 80% stocks and 20% bonds, but it's invested in all sorts of different types of styles and flavors. This is what you should be looking for in your portfolios. Okay, why should you start investing? This is a 10% a year growth between 0 and 40 years of investing. 10% is just kind of a nice round number. It's maybe a little bit more than you can expect to get from just stocks. But look at what happens. Like the first 10, 15 years, it's kind of boring. You go from 1,000 to 5,000. That's still a pretty good return, right? But then the longer you stay invested, all of your profits start earning profits on themselves. Your interest starts earning interest. And this compounding thing starts to happen where between 35, like year 34 and 40, the amount of money in your account can literally double. This is why they say start investing early for retirement. And if you didn't start doing it when you were 20 years old, it's okay. You still have 20 to 25 years to do it and participate in this growth.